Good afternoon, everyone. My name is Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for this webinar with George Latham, the Managing Partner of WHEB Asset Management, and Seb Bilo, the Head of Research. WHEB is a single strategy funds management business focused entirely on sustainable and impact investing. They're based in London, so we have dragged them out of bed very early this morning. They have managed the Pengana WHEB Sustainable Impact Fund since August 2017, when Pengana acquired the fund through the merger with Hunter Hall. The team are globally recognized as leaders in the field of impact reporting and measurement, and today they are going to update us on the findings from their 6th impact report entitled Solutions in a Time of Crisis. During the presentation, if you have any questions, please enter them in the question box on the top right-hand corner of your screen, and we will get to as many as possible of them in Q&A at the end. Please note the disclaimer, and George, over to you.
Thank you, Adam, and welcome everybody. Thank you for joining us this afternoon for this webinar. My name is George Latham. I'm the Managing Partner of WHEB Asset Management, and I'll be joined shortly by Seb Bilo, one of my other partners and our Head of Research. So for those of you who don't know us well, WHEB is a specialist investment boutique. It was founded in 2009, but as you can see from the slide, our strategy was first launched at the end of 2005, beginning of 2006. We run a single investment strategy, which has sustainability and positive impact at its very core. And for most of the team, sustainable investing has defined our whole careers. We came together to build WHEB because we want sustainable investment to define our whole business, not just the investment product. This is written into our business mission, which is to advance sustainability and create prosperity through positive impact investments. Now we have something of a phrase at WHEB that Latham loves a logo, and we seem to have gone overboard on this slide. We've really got an amazing blizzard of logos on here, but it really sort of, although we may be a firm that many people might not have heard of, we're still a small boutique, but we are one that is recognized quite extensively for our expertise in this area. Amongst the number of logos on this slide, we're particularly delighted this year to have been awarded the Investment Boutique Manager of the Year at Environmental Finance's Sustainable Investment Awards just a couple of weeks ago. And at the Investment Week Fund Manager of the Year Awards this year, we won the Outstanding Achievement in Sustainable and ESG Investing Award. And we're also extremely pleased to be working with Pengana in Australia and to be highly recommended by Lonsec and also approved by Zenith in the Australian market. So our strategy was first launched, as I said, in 2005 and was the first multi-thematic positive impact strategy in listed equities. And for many years, we had very few peers, but in the last 2 to 3 years, we've been very flattered to see quite a range of followers launch funds which imitate our approach. We've always focused on investing in companies whose products offer solutions to sustainability challenges, defined in these 9 themes that you see on this slide. We're looking to invest our clients' capital in companies which are aligned with and benefit from the transition to a zero carbon and more sustainable economy. So with that short introduction there, this is our agenda for this morning. I'm going to provide some context first for WHEB's impact reporting and our experience in this area for about the first 5 or 6 minutes or so, and Seb will then take over and speak for about 30 minutes. So we'll be speaking all told for nearly 40 minutes, and we'll have a good 20 minutes, as Adam said at the beginning, for questions, which you can submit using the Q&A function on the system. So we started measuring and reporting on the positive impact associated with our investments back in 2014, having been listed on the Global Impact Investing Network's impact base as an impact investment fund. And so over the last 6 years or so, we've led the field in developing new methodologies for reporting impact. And we believe with this year's report, we've broken new ground yet again. This is overall an exciting time to be involved in sustainable and impact investing. And I can assure you that looking back over the last 20 years or so of our experience, this hasn't always been the case. We don't want to go into a discussion about terminology here, but suffice it to say that, at least for us, sustainable and responsible investing has become something of a catch-all term. whereas impact investing is more narrowly defined around an intentional impact that can be measured. And the key point I want to make from this slide up front is that interest in sustainable investing is high. On average, across different studies over the past few years, they find that 70% of people are interested in investing sustainably. We can dissect this data in many different ways, but that is the principal message. Most people are interested in sustainable investment. And over the past 2 decades, surveys have been quite consistent about this. But for too long, there's been a big gap between this strong level of interest in sustainable investing and the amount of money which is actually invested in this way. Over the past 5 years or so, we've seen a strong positive inflection in the amount of money that's being invested in positive impact investments. The chart on the right-hand side of this page shows data from the Global Impact Investing Network, showing over $700 billion invested in impact investments in 2019, up from under $100 billion in about 5 years ago. Just moving on the slide. So I said we didn't want to talk too much about language and terminology, but I think it is worth saying that the complexity of the language is off-putting to people and often confusing. A recent survey by 2 Degrees Investing Initiative asked people who said they were not interested in impact funds to say why, and nearly half of them, 48%, said that it was because they thought that claiming impact was probably just a marketing trick. 2 Degrees Investing themselves believe that the vast majority of funds claiming to have a positive impact are at best ambiguous or confusing about their claims. So the positive momentum being seen in impact investing does risk being undermined by greenwashing and investor mistrust. So the impact investing industry has made some attempt to explain the difference between the various different approaches to sustainable and responsible investing. And many of you may be familiar with this spectrum of capital graphic, which was originally developed by the Impact Management Project. And here we've adapted the work of the Impact Management Project and highlighted where we aim to be with WHEB's investments. One interesting aspect of how different people approach this debate is that it very much depends on their starting point. Typically, family offices, foundations, charities and endowments have had their first encounters with impact investing as an extension of their philanthropy and grant giving. Hence, they've worked their way in towards return-seeking impact investments from the right-hand side of this spectrum. And as they do so, a greater percentage of their investing portfolio can be aligned with their mission and invested for a positive purpose. On the other hand, for retail investors, for pension funds, private banks, wealth managers and IFAs, typically their first encounter with this spectrum has come from the left-hand side. Here, the move towards impact investing in listed and liquid markets represents an evolution of the sustainable and responsible investing style beyond simple ethical screening and ESG integration. And as they move from left to right, the intensity of the engagement with sustainability in investing becomes ever greater. So key to addressing the risk of investor misunderstanding, confusion or mistrust in our view, is to drive for ever greater transparency in the investment industry. And this rather detailed image of WHEB's timeline, which is taken from our impact report, it shows one of the key advantages of being a focused and specialist investment boutique is that we've been able to put in place what in industry terms is quite a radical approach to transparency and accountability towards our investors. We are still one of what is a very small number of UK fund managers who are able to carry the Eurosif transparency logo, which is shown towards the middle of the chart. Our independent investment advisory committee challenges us on every holding in the portfolio, and we then publish the minutes of that meeting. That's almost unique, I think, amongst the fund management industry. And our transparency is embedded in our commitment to being a B Corporation. We do this on principle, but it's also, frankly, because it's a good way of managing risk and building stronger relationships with our clients. So with that, hopefully giving some context, I'm going to hand over to Seb, who's going to take us into the report and into some of the rest of the agenda.
Very good. Thank you very much, George. Good afternoon, everybody. So I'm Seb Bilo. I'm the head of research here at WHEB. And as Adam has said, this is our 6th impact report. We think it's the best one that we've done so far, and we hope that you will too. As George said, I'm going to spend about 30 minutes, first of all, introducing our approach to impact and how we think about impact, and then going through the main points from the latest report before finishing with some brief comments on the outlook for the strategy in light of COVID-19. So the title that we chose for the report is Solutions in a Time of Crisis, for obvious reasons. And I'll come back to that question of what the COVID-19 pandemic means for sustainable investing later on. But I think one important feature of the pandemic, and indeed society's response to it, is that we all now know what it feels like to be in a real societal-wide crisis, and it's not a comfortable place to be. Even now, as we're slowly emerging from the worst parts of the pandemic so far, at least, the prospect of more crises, whether health-related or linked to climate change, is deeply uncomfortable. And as a result, I think more than ever, people are looking for solutions. And they're looking for companies which can help solve the problems that they face and help them get back to some kind of normal life. Now, clearly, we're having this debate about COVID-19 at the moment, but I think it's clear that we will all feel this way, and this tension around other crises, particularly perhaps with regard to climate change. And this is what the WHEB Fund is focused on. We invest in companies that are providing solutions to the world's great challenges. As many of you will, let's just move on to the next slide. Is that working? Sorry, there we go. As many or some of you perhaps have heard us say before, when we talk about solutions, we mean very specifically the companies that are selling products and services that are directly addressing the challenges in front of us. So on this little chart here, we clearly don't invest in the companies on the left-hand side of the chart, 20% approximately of the market, companies that are exposed to a permanent loss of capital as the market moves away from the products that they supply. We also don't invest in the 60% category in the middle, companies that supply products that we all know and enjoy, but at least in our view, aren't providing a solution to a sustainability challenge. What we focus on is the companies on the right-hand side, again, about 20% of the market, companies that the product is directly addressing a critical sustainability challenge. The 3 examples I've given there, Aptiv is a company that makes components that go into electric vehicles. In our view, electric vehicles are one of the key parts of the solution to reducing greenhouse gas emissions from transport. Thermo Fisher, which I'll talk about a bit more later on, one of the things that they do is supply diagnostic tests for COVID-19. And then TPI Composites, their main business is in manufacturing turbine blades, wind turbine blades for renewable energy. So hopefully you can see in each of those cases, the product is directly addressing a critical social or environmental challenge. And the key other dynamic to recognize is that every time that their revenue growth is absolutely aligned with their positive impact. So every time they sell another product, obviously their revenues grow, but also their positive impact grows as well, because the product is what's delivering the positive impact. So that relationship is extremely important and a core feature of our investment process, and is very different to the other 2 categories where you don't have that relationship. So just on the next slide, our focus is very much on 9 investment themes. I'm sorry this slide is a bit small. Hopefully one of the advantages of Zoom is that you can all peer a little bit more closely to see the text, but even then it's probably a bit small. But we've got the 9 different investment themes across the top that we focus on. These were originally developed, as George said, in 2005, 10 years before the UN Sustainable Development Goals were developed. But you can see how, running down the chart, they're aligned, those 9 themes are aligned with 7 UN Sustainable Development Goals. Those are the 7 that we believe we're directly supporting through our investments. 3 of our themes, safety, health, and well-being, all feed into SDG 3 on good health and well-being. And then you can also see in the chart, we've identified in that first row the types of markets that we're focused on, so what we consider to be consistent with the theme. And then also under that, we list every single holding that's in the portfolio or was in the portfolio at the end of 2019, and in the different themes. So you've got the names of all of the individual businesses. And then the final part of this table is we do actually collect data on the real-world impact of the products and services that are being supplied by the companies. So, for example, we've got data here on the amount of renewable energy, 300,000 megawatt hours of renewable energy that was generated as a consequence of the products and services sold by the companies, 300,000 tons of CO2 emissions avoided as a consequence of the use of the products from the sold by companies in the portfolio, and then other metrics as well around waste, water, and health and education too. And I'll come back to some of this a little bit later as well. So just turning to the next slide, a major focus in our report and in the investment process is this focus on the positive impact of the products and services sold by companies in the portfolio. Our belief is that companies that sell products and services that are addressing our 9 investment themes and the 7 Sustainable Development Goals are well placed to enable and benefit from the transition to a safer, greener, and cleaner world. So the focus is principally on how the product creates positive impact. And the example I've given here is a company called Smurfit Kappa, which is an Irish-based business that makes recycled cardboard packaging. We like recycled cardboard packaging. We think it's a very sustainable packaging material. It's lightweight, so it helps to reduce emissions in the logistics chain. And of course, it's recyclable and also biodegradable. So it gets around the problems that a lot of plastics face. And they're very proud of this new product that they've developed called the cardboard top clip, which is used to bind beverage cans together and of course replaces the plastic ring pulls that we're used to. And this is essentially what the company does. It develops and supplies recycled cardboard packaging. We do also look at how a company operates as well, which is principally the so-called ESG, environmental, social, and governance issues. You know, how a company operates, how it manages its own operational footprint in terms of environmental impacts, health and safety, supply chain issues, how it's governed, and I'll come back to that a little bit later. But I want to focus at this moment on the impact of the products, which is obviously core to what we do. And we've recognized for some time that it's not just a binary question, you know, positive or negative impact. There are actually multiple dimensions to the concept. And in this year's impact report, we introduced what we've called our impact engine for the first time, which captures these multiple dimensions of impact. And we believe that more and more focus will be on this issue, how a company creates positive impact and how intense that impact is. So our impact engine draws inspiration from the work of the impact management project and the Future Fit Foundation. I'm just trying to get the slide to move forward. There we go. And it's structured around 5 questions, each tackling a different dimension of the product impact. So the 5 questions there on the left-hand side. So the first question is, you know, who is the customer? How vulnerable and underserved are they? And then secondly, how critical is the impact to them? Is it a life-saving impact, or is it just you know, more broadly beneficial to them? How central is the product or service in delivering the impact? Is it just a component, or is it the active ingredient that delivers the impact? How large is the improvement against a specified baseline? And then finally, how unique is the product contribution? Is this the only way of achieving the impact, or are there other alternatives that are on the market? And when we take a product through the impact engine, we're rating each of these questions from 1 to 3. And then the rather complicated little diagram on the right hand side shows you how we then multiply those scores together to get an overall score, which we then turn into a percentile ranking. And then we then multiply that by the proportion of revenues that the company's getting from that product category. And that gives you an impact intensity score for that product. Of course, if a company has more than one product category, then we do this process again for that other product category to generate an overall impact intensity score for the company. So this is a really important new innovation for us. It gives us a much more nuanced understanding of impact and where that impact is coming from. And of course, it allows us to compare companies that are doing very different things with very different types of products together. So we can then plot that on a table. This next slide, struggling to get this to move forward. We can then plot that on the table. We bring together both the analysis of how a company operates on the y-axis, looking at how a company operates, which looks at things like the business model, the operations of a business, the ESG components that I mentioned earlier on, and we have a methodology for generating a score on that dimension of a company's characteristics, if you like. And then we also then have on the x-axis the impact engine score, and that allows us then to plot the overall of a company relative to others. All companies have a positive impact in our fund, but some are more intensely positive and at higher quality than others. I've given you the position of 3 stocks that are in our portfolio today, which I'll go through in a bit more detail in a second. But you can see the overall portfolio here on this map. So this is a new innovation for us. It's still very unusual. We're not aware of any other similar tools that are used systematically in listed equities, at least. But we hope that it's recognizable from the other frameworks that have been developed, like the Impact Management Project. We don't want to sound too grandiose about it, but we do believe, as I said earlier, that over the coming years, we think that alongside risk and return, impact will come to be seen as a critical component in investment decision making, not just in impact investing, but across the market as a whole. And this is our first effort to try and codify this and make it a systematic element in our investment analysis. And over time, of course, we'll want to graduate towards that upper right quadrant. We believe that high quality businesses that have strongly positive impact products and high quality operations and management are well placed to deliver superior financial returns over the long term. So that's an important part of a new part of our investment process, and also of how we report publicly. There is an interactive version of the impact map actually that's available on the Pengana website. So you can go onto that and actually kind of mouse over each of the plots, the scattergrams, to see which of the different companies that are in the portfolio. But beyond the impact map, we do also measure what the ultimate impact is in the real world of the products and services that are sold by portfolio companies. How many tons of greenhouse gas emissions are avoided? How many people benefit from healthcare therapies? And we've been calculating this impact for the last 4 years and have updated the data in our latest report. So if we just turn to the next slide, you can see the updated numbers for the report this year. And we do discuss in the report what has changed and why. But perhaps it's worth just sort of giving a little bit of a health warning. As George mentioned as well, we don't want to be accused of overclaiming for this impact. The impact is really owned by the companies, and perhaps even more so by the individuals that are actually using the products and services. It's not really owned by us as investors in the companies that manufacture the products. But as investors, WHEB and indeed our clients are clearly aligned with this positive impact by investing in these companies. So in addition to the positive impact data that's there, and I'll let you read in the report how that's changed year on year. But one other notable thing that we saw this year was an increase in the number of companies that are actually reporting data themselves, which is a very welcome development. So this year we had 56% of companies reporting data themselves, which we then can use. And we estimated a further 14% data for a further 14% of companies. So overall, the report and the data in the report covers 70% of the portfolio. Last year, the equivalent numbers were just 40% of companies reporting data themselves, and we estimated 21%. So that the report previously covered about 60%, now it's 70%, which with a much larger proportion coming from data reported by the companies themselves, which is great. We're really pleased to see more and more companies report this kind of data. The other development which we did this year was that we had our methodology for calculating the impact peer-reviewed by an organization called the Carbon Trust. Impact calculation methodologies have become more popular in recent years. I think we were the first about 4 years ago to launch an impact calculator. We've seen many others now come to the market, and we felt like it was appropriate to have our methodology properly peer-reviewed, which we did do using the Carbon Trust, and they concluded, just to quote, that our methodology was based on reasonable assumptions and estimations, and was consistent with international best practices. So we were very pleased to get that stamp of approval from the Carbon Trust, and you can read the full statement, which is in our methodology that's on the website. So just now turning to the different themes and the different companies, I did want to come back to this idea that the core philosophy of the fund and our focus is on companies that are providing solutions to sustainability challenges. That is the central feature of our investment strategy. So I'll just walk through those 3 company examples to give you a flavour of the kinds of companies that we invest in and the positive impact that they're having. And the first one is in the health theme, which is one of our larger themes. So Thermo Fisher Scientific, which I mentioned earlier on, a large company that many of you may be familiar with. We've owned it since the start at WHEB back in 2012. So for over 8 years, we've owned it in strategy. And they have a wide range of businesses that mainly manufacture equipment and consumables to be used in healthcare to do research and development, but also for testing and diagnostics. And as I mentioned earlier on, Thermo Fisher has been one of the main suppliers of COVID-19 test kits globally. And you can see the different elements of the process, the testing process here on the slide. Back in May, the CEO announced that the company was making 5 million test kits per week. That was updated a couple of weeks ago. They're now making 10 million test kits per week. So really, Thermo Fisher is really in the engine room, if you like, providing society with the tools to help address the COVID-19 crisis. The second theme that we've profiled in the report is our resource efficiency theme. Primarily, this theme is focused on products and services that help to reduce energy use, but also other types of resource and material use within downstream clients. And the company that we've profiled in the report is DAIKIN, a company called DAIKIN, which is another large company whose largest business is in manufacturing air conditioning systems. The demand for cooling is growing extremely rapidly globally, both because of more wealth in emerging economies and hot countries in emerging economies, but also, frankly, because the world is already warming. We own DAIKIN in our resource efficiency theme because they have developed technologies that lower the energy intensity of air conditioning by about 30%. But you could also see cooling as a critical adaptation to climate change as well. 2.3 billion people could be exposed and vulnerable to heat wave events with just 1.5 degrees of warming, and that's a threshold that could be reached within the next 10 years. So there's going to be significant demand going forward for cooling. And you can see that in this chart on the left-hand side on this slide. This is showing you the carbon emissions that are connected with cooling. So in 2016, we've got just over a gigaton, 1,000 million tons of of carbon emission equivalents, carbon dioxide equivalents, coming from cooling in 2016. According to the IEA, the International Energy Agency's a baseline scenario, by 2050, on current trends, this could double to over 2 gigatons of carbon, which is clearly completely inconsistent with trying to keep global warming below 1.5 degrees. And so you can see they've also developed a scenario, what they call their 2050 efficient cooling scenario, that last column on the right-hand side, where you see radically reduced carbon emissions from cooling. And the way that we get there is through more efficient air conditioning, which is responsible for about 40% of the reduction, and then decarbonizing the electricity supply, so using renewable energy rather than fossil energy, helping to provide the rest of the 60% reduction. And so this is a critical challenge to get this right, to develop more efficient cooling systems and more renewable energy that will help us keep the environmental impact of cooling below where it would otherwise be. And we think DAIKIN is extremely well placed to address this. They are, for example, also one of the companies that's been shortlisted for what's the Global Cooling Prize, which isn't a prize for the best dressed CEO, but it's a competition to develop a radically more efficient air conditioning system, which is being led by the government of India and a US organization called the Rocky Mountain Institute. So that's DAIKIN. And then the final theme that we've got in the report is our environmental services theme, which covers a range of businesses and activities, including businesses that have exposure to circular economy type business models, and also businesses that are developing novel new materials that have much lower environmental impacts. And the company that we've profiled in the report is a company called DSM, which is a Dutch company. Actually, DSM originally, the acronym originally stood for Dutch State Mines. The company was set up back in 1902, actually to mine for coal, perversely enough, in the south of the Netherlands. And it's one of these quite unusual businesses that have managed to evolve their business model several times over history. So originally coal mining, they then went into commodity chemicals. They're now a specialty chemicals business, and also a business that does develops new nutritional products. The two products that I've profiled here on the slide, you've got a product called Veramaris on the left-hand side, which is a business that develops and produces algae in big fermentation tanks, and the algae produces something called omega-3, which is a big constituent in fish food, and this replaces the wild caught fish that would otherwise be the main constituent in fish food. So much lower environmental impact associated with what they're doing compared to what's traditionally done. And then the other example is a product called Niaga, which is a solvent-free resin that enables 100% recycling of carpets and mattresses. So these are just two of the types of products that DSM produces that are helping support lower impact businesses and activities among their client base. So those are the three examples I wanted to give of positive impact products. I did also say that we would cover the ESG profile of the portfolio, and for the second year we've actually used a company called Impact Cubed to profile the strategy. We don't actually use their data in the investment process. This is more of a snapshot of the portfolio holdings, the output of the investment process. And their methodology covers 14 different metrics. 4 are focused on products and services sold by portfolio companies, and of course, happily, we perform very well on those. There's 4 between kind of 5 o'clock and 8 o'clock on this little chart, and then 12 other metrics that are focused on different dimensions of E, S, and G. And you can see that we're broadly in line with the market on these dimensions, within a margin of error anyway, except for 2 major anomalies on the right-hand side there, sort of 3 and 4 o'clock. 1 negatively on gender diversity, and then 1 positively on executive pay. And we think these are really driven mostly by the types of company that we invest in relative to the index. So for example, we invest in a lot of engineering and science-based companies, which tend to have a larger proportion of men in them. And then we invest in mid-cap sized businesses that tend not to pay the extremely high salaries to their CEOs that their larger cap cousins do. So it's really a product more of how we invest than anything. But of course, I mean, we still recognize that we need to do better on issues like gender diversity. This has been a big engagement issue for us over this year, with still somewhat limited success, but it will be continue to be a priority for us, and we hope that we'll be able to improve on the scores in the coming years. There is also a section in the report, a whole section of the report on climate change. We've reported using the TCFD framework. All of our environmental themes have a connection with action to mitigate carbon emissions, and we believe that they will be beneficiaries of further efforts to reduce emissions. But traditional carbon footprinting doesn't tell the whole story. In fact, it can be downright misleading in our view. If you invest in funds that are chock full of banks and consumer technology stocks, you will have a very low carbon footprint, but you'll also be doing very little to solve or to contribute to solutions to climate change. If you want to invest in companies that are actually providing solutions, you do kind of have to roll your sleeves up and get your hands a bit dirty and invest in companies that actually make stuff. And so your carbon footprint will be sizable because you do still need energy to make stuff. So the scope 1 and 2 emissions of the WHEB fund is still marginally better than the index. It looks, I mean, it's essentially the same, slightly better on the left-hand side of the chart here. But the main reason that it's not substantially better is that the index has become substantially lower carbon in recent years. In 2014, when we did our first analysis of scope 1 and 2 emissions, the index had emissions that were 3 times that of our strategies. But since then, the heavy footprint sectors like oil and gas and mining have fallen precipitously as a proportion of the index, while light footprint sectors like consumer tech have grown enormously. And we've stayed more or less constant, but and now making anything uses quite a lot of energy relative to the index. So our allocation effect, the structural effect of being exposed to industrial companies that make low carbon technologies is actually now a negative influence on our scope 1 and scope 2 carbon footprint. And we managed to offset that by selecting the most efficient companies in those sectors, which is why our footprint is slightly better than the index. And then on scope 3 as well, you might ask, why is it also worse than the index? And it's also a bit counterintuitive, but the reason is actually that a significant proportion of the WHEB strategy is invested in companies that make equipment that use energy. And this is what the scope 3 category measures. But the key point is that the companies we invest in make equipment that uses energy more efficiently than competing products. So like the DAIKIN example that I gave earlier on, where their air conditioning systems use a lot of energy, but they use about 1/3 less than competing systems. So efforts to improve energy efficiency will benefit them and reduce carbon emissions from what they would otherwise have been. But they still use energy. So compared with an index, which has lots of companies selling products that don't use any energy at all, like food, beverages, and most non-electrical consumer products, our profile looks relatively poor. And I think in many ways, the final chart on this slide on the right-hand side, the avoided emissions per £1 million invested, is the most useful one. Although it's not without its own methodological challenges, it does measure what we are trying to do with the strategy, which is, among other things, to provide solutions that reduce carbon emissions. And the chart demonstrates that we are actually achieving that. So the final element of impact that I just wanted to touch on in the report is the engagement that we do with portfolio businesses. There's lots more detail in the report and also on the Pengana website. And it's a pretty good story here, actually. we do a lot of engagement. We engage with over 80% of the companies in the portfolio every year. And we have an average holding period of around 6 years, 7 years. So these companies hear from us a lot. We're writing to them generally at least once a year. It's not just on the traditional corporate governance type of issues. That still is a large part of our engagement, but we're doing more and more around social and environmental issues. You can see those on the pie chart on the left. Issues like climate change and gender diversity have been big focus areas for us this past year and will be again this year. And then the fourth segment there, ESG, disclosure and governance, we still have to do quite a lot of engagement trying to get companies to report more detailed ESG data. It's still a challenge, unfortunately. Sad to be saying that in 2020, but still we need to get companies to report more data, and we do a lot of engagement around that. And then on the right-hand side, one of the things that we've done for many years is to try and assess the success or the impact, at least, of our engagement. And we categorize our engagement into these three categories: successful, partially successful, and unsuccessful. And we've been doing that since 2014. And you can see over the 6 years how the proportion of unsuccessful engagements has come down significantly over that period, from around, this is numbers of engagements per year, but you can see how that's come down, and then also how the number of successful engagements have increased, and also the partially successful have also increased. So that's a pretty good story. We can't claim credit for all of that, we don't think. I mean, ESG has become a bigger focus for a lot of asset managers. There's a lot more engagement happening, and we think that's part of the reason that this has improved. But we do also know of several examples where companies have moved, ultimately because of the work that we've been doing at WHEB. So just to conclude, really, with a quick outlook on where we're going next and what does the future hold for sustainability and sustainable investing. And this next slide, I particularly like this quote from the science fiction writer William Gibson. I'm sure some of you will be familiar with his work. I think one of the biggest impacts of the lockdown has been that it has accelerated change, particularly in the move from the physical to the digital world. And the future, as it were, that formerly existed in little pockets and niches in our economy has become much more mainstream. This has been most visible in the shift to online activity, not just in video webinars like this, but in our shopping behavior, medicine, education, and a lot of other areas have moved definitively online. But the disruption has also shifted other sectors like energy and transport, and has accelerated the underlying shift to renewables and electric vehicles, respectively. A year ago, a group of scientists, some of you may remember, a group of scientists warned that we had 18 months to put in place the regulatory and market infrastructure that we need to address climate change. Any longer than that, in their view, and it was going to be too late. That was a year ago. A couple of weeks ago, the International Energy Agency confirmed that we do have about 6 months now to get this right. And so there's a big question, I think, about COVID-19 and whether it's come at a particularly bad time with respects to address efforts to tackle climate change. I mean, has it disrupted the trajectory that we were just beginning to get on in terms of policies and market frameworks to address climate change? Or might it actually catapult us forward by accelerating underlying shifts in economic activity that were already happening? Obviously, we don't know the answer to this. I'd like to believe that the importance given to climate change in the stimulus packages across Europe, as well in some parts of Asia, might be this catapult. And that has happened as a consequence of COVID-19. But really, the European story is just part of the story, and probably less than half, actually. We obviously have President Trump, and he looks like he's going to be supporting incumbents in the oil and gas sector with much more modest support to green industries. And then, of course, we have China and India. And it's still, I think, too early to tell exactly how that's going to play out, although the early signs aren't unfortunately very promising there. But whatever governments ultimately choose to do, we do think that the post-COVID-19 world will be different, at least in 3 key respects. First of all, we do think that there will be a much greater focus on health, and particularly more investment in systems to monitor and diagnose and respond quickly to the emergence of future pandemics. We also think there's going to be a bigger focus on safety as well, more social distancing, more online activity, probably less travel. And then finally, and perhaps most importantly, a big focus on resilience. Resilience in business processes and supply chains, probably more regional and local supply chains, but also more focus on flexibility and responsiveness that's enabled by more intelligence being embedded in systems and infrastructure. And some of this focus on resilience, we think, will undoubtedly be of value as the climate changes as well. So the WHEB strategy is invested in the companies that provide the solutions that will help society to adapt to this new world. And ultimately, that is what our strategy is about. And I hope our report makes that very clear. So thank you very much for listening. And I think we have a time for questions. Don't we, Adam? I think I'm going to pass back to Adam.
Yes, thank you very much, Seb. We've received a lot of questions and others are still coming through. Many seem to have common threads, so in the interest of answering as many as possible, I'm going to try and combine them. We'll see how I do. But if you don't hear your exact question, it's possible that it's been phrased slightly differently or asked as part of a multi-part question, so please bear with me. The first question I have received is the impact engine an input into the investment process or just a reporting tool? And related to that is, does it influence investment decisions and particularly investment weightings? You had mentioned, for example, DAIKIN and TPI composites, but TPI would seem to have a far higher impact.
Yes, thank you very much. It's a good question. So just on the first part of that question, no, it's not just a reporting tool. This is absolutely in the heart of our investment process. When an analyst does an initiation on a new potential investment, the impact engine is something that they use, we use to assess what the attractiveness of that potential investment. So it sits in our investment process, and the reporting really is to demonstrate how the investment process works and what we look at in our investment process. So it's first and foremost about the investment process, and then about reporting. To your second question about whether it does frame a conversation about whether we want to invest in companies. Of course, it's one part. It's not the only thing we're looking at. We are looking at quality as well. If you have a very high impact intense scoring company but they're rubbish from an ESG point of view, then that's not a particularly attractive investment for us. And then the third element is obviously valuation as well. So it's those 3 things that go into the investment decision. In terms of weighting, the impact engine will be part of that, but to be honest, we don't have big differences in weightings. The fund is run with a relatively flat structure. We have 3 levels of conviction, A to C, running from, I think it's about 2.5% down to about 1%. So it's pretty flat. And that tends to be more driven by issues around the level of risk. So TPI Composites is a small company. It's got a pretty bouncy share price if anyone's ever looked at it. And we want to manage that risk quite actively. So we tend to hold those kinds of companies at relatively low weightings, even though they have high impact scores. Companies like Thermo Fisher would be also actually very high scoring from an impact point of view, but a much more stable, much larger business, a much more kind of consistent share price. So those are some of the considerations that we take into account when we're thinking about conviction.
Thank you. Next question, should we expect to see the lowest scoring companies leave the portfolio over time?
Yes, and in fact, on the impact map, if you look at the lowest scoring company, it's a company called Norma. We've said goodbye to them actually, even since we did the impact map. they were in our sustainable transport theme, but a relatively low impact company. So we have sold them. And part of the reason we sold them is because they have a low impact score. Not the only reason, but that was certainly part of the reason we sold them. I would, though, just sort of caution that we don't, I'd said in my comments that we want to move over time to the upper right quadrant, and that's absolutely our objective over time, but it's not going to be a direct line. You know, there are lots of other things that we have to think about when we're making investment decisions. And in any one year, it may not go in that direction, but we would hope over 5, 7, 10 years, absolutely the direction of travel will be higher impact and higher quality.
Great. Next question, when assessing whether a product or company creates a positive impact, how are any negative impacts that may result from the development of that product considered against the positive impact? I.e., how is it deemed that the pros will outweigh the cons?
Yeah, that's a great question as well, and that's very much a part of the impact management projects approach as well. It makes sense, doesn't it, to make sure that you're thinking about these things holistically. The way we do that is it's more in the a lot of these trade-offs take place between, you know, the positive impact of the product and then the processes that are used to manufacture that product. So I mentioned Smurfit Kappa in the presentation, this recycled cardboard manufacturing business. Recycling cardboard uses a lot of energy, and Smurfit Kappa is one of the largest contributors to our Scope 1 and Scope 2 carbon emissions. And you know, so we recognize that as an issue and as a risk to that company, and the way that we deal with that is by, first of all, making sure that they are better than their peers. So we like recycled cardboard as a packaging material. We think it's more sustainable than the alternatives. How can we make sure that that's delivered with as lower an environmental impact as possible? Or we make sure that the company we're investing in is the better performing one within their peer group, and Smurfit Kappa are. And then we do a lot of engagement with Smurfit Kappa to try and get them to focus on reducing those emissions further. And in fact, one of the case studies that we've got in the on the website is about Smurfit Kappa, and the focus of the work. Well, we've done a number of things with them, but one of them has been to get them to set a net zero carbon target, which we're still working on them to get them to do. But they have now signed up to this science-based to have a science-based targets based target, which they will set, and that has to be Paris aligned. So that's kind of, we recognize those negative impacts, we identify them, and then we put in place processes to try and mitigate them.
Great, thank you. Next question, are you assessing the vulnerability of the companies in your portfolio to indirect COVID-19 risks, example, trade barriers, supply chain failures, credit squeezes, etc.?
Yes, absolutely. Yeah, I mean, that's been a key focus for the last few months. One of the characteristics of our investment process is that we're looking at very high quality companies, and both from an ESG point of view, but also just in terms of how they manage their operations. And so we've had a style of trying to avoid companies that are heavily indebted, companies that have relatively strong balance sheets. And that's obviously something that's put us in pretty good stead for the current crisis, where there's been a focus on companies that are indebted and might be vulnerable as a consequence. So that's been a long-standing part of our investment process. The issue about supply chains is a bit more difficult for us. A lot of companies, when you think about environmental themes in particular, if you've got a new technology that helps to reduce CO2 emissions in North America, then it's probably going to be good at reducing CO2 emissions in Asia Pacific and in Europe as well. And so often these are businesses that have developed new technology that they sell globally. And for some of them, the trade tensions, and now, I mean, COVID-19 in a way has been an extension of the existing issue we had around trade with the China and US tension. And that has been a challenge for some of those businesses. And they are, many of them are now looking at how they make their supply chains more resilient. My colleague T. Lee actually has just written a blog entitled From Just in Time to Just in Case, which is the way that a lot of companies are now thinking about supply chains. How do you build in more resilience, more regional sort of supply chains, less dependence on very sensitive, just-in-time global supply chains. So that is something that we've looked at, and if you're interested, have a look at T's blog, which is on our website, and that talks a lot more about our approach to that.
Great, thank you. Next question, does the portfolio have any exposure to hydrogen? Apparently there is a lot of work being done in the UK to replace natural gas with hydrogen, and hydrogen vehicles have been shown to have certain advantages, and this question is around that.
Yes, I mean, yeah, so hydrogen is, a really interesting new area. It's still relatively new as an area. The EU, as part of their recovery plan, have put a lot of money, or going to put a lot of money behind hydrogen. Our view is that hydrogen is particularly, I mean, obviously hydrogen is typically produced through from natural gas, and so actually current hydrogen production isn't particularly low carbon. You produce a lot of carbon when you get the hydrogen out of natural gas. So what we need to see is the development of more green sources of hydrogen, which you produce typically through electrolyzers, where you take water and you use electricity to produce hydrogen and oxygen, and that's still relatively expensive. We think that hydrogen will become a solution in areas like heavy industry, so in steel making. It could well be used also in heat networks. So instead of using natural gas for heating, you'll start to use more hydrogen. It could also be used in transport. We don't think it'll be used in car, light vehicle transport. We think battery electric vehicles have really got too much of a head start there. It could be used though in heavy goods vehicles transport. It can be used in shipping and perhaps even in aeroplanes as well. So there's definitely a bright future for hydrogen, but not, we don't think, in light vehicles. Our exposure is mainly through the industrial gas business, Linde. They do have an existing hydrogen business. They're a very large company. They supply other products as well, oxygen in particular, which is used in water treatment and steel manufacturing. But they have we believe that they're well placed to do well when hydrogen becomes a bigger part of their business. There are other smaller businesses that we've looked at, but we haven't yet invested in any of them. So Linde is really our main exposure to this growing area of hydrogen.
Great, thank you. We've only got a few minutes left, so I'm going to try and get through two questions in that time. The first is slide 15, reference to China Everbright. Do you assess modern slavery and human rights issues on a country basis?
On a country basis, so specifically around China. We do, in a sense. I mean, we do look at where companies are based. We have another business called Hikma Pharmaceuticals, which is actually a London-listed company, but they have big operations in Middle East and North Africa. They're a generics medicine manufacturer. So in our health theme. So, for example, a business like that, we would automatically, because of the issues around human rights and also bribery and corruption in those markets, we will look at those issues much more closely than we would, a software business that's located in North America. So China Everbright, they run a variety of environmental facilities, waste to energy facilities, water treatment, renewable energy as well in China. Because they're in China, we will look at their approach to human rights more closely. But it's more at the company. The risk is because it has activities in countries where there's more human rights risk, and that's the red flag for us. And then we look at the company's approach. So that's the way that we think about that.
Okay, I think that in the interest of time, we'll have to wind things up. If your question wasn't answered, we will respond to it directly. I recently reread all of WHEB's impact reports in chronological order, and what is amazing to me is how clearly you can see the progress as they have developed their thinking and enhanced their methodologies year after year, and obviously produced more meaningful reports in the process. I think that the Impact Engine is a major leap forward, both in terms of how it informs the investment process and the reporting that it enables. So we look forward to seeing, the next iterations of your reports. Thank you very much for joining us today, everyone. We hope you found this an interesting session. And if you have any other questions, please get in touch. We'd love to hear from you.
Thank you very much.
Thank you.